Hello YouTube, let's talk about my Robinhood portfolio. Right now for the week, I am up 0.20%, and for the past month, I am down 0.56%. So today, it looks like I was slightly up $4.55, and I'm going to quickly talk about what I've been doing for my plays for the week. I know I've been saying in the last video how I've been trying to avoid industrials. There's a lot of news about this trade war. The tariffs are back, and a lot of people are still looking at China very heavily. They're trying to determine how China's going to be doing here for the next couple of weeks or so. But China's economy is very important towards the investors in the U.S. They definitely monitor all the things that are happening in China right now, and if China's growth is slowing down, then that is a major concern for investors because their economy is so big. It's much bigger than ours. And, China just has so many people, in their nation. So we're going to quickly talk about what I've been doing. Like I said, I've been trying to avoid industrials, but there was one industrial, guys, that actually hit a very good pricing point, and I ended up buying that industrial, and I'm going to quickly say what it is right now. But let's just dive into portfolio. You guys will see right quick what I am doing. And let's take a look at Apple. Right now, Apple is going down because of a lot of the China fears are priced into Apple. Many investors are afraid that, if the China sales are not doing good, then a bulk of, Apple sales comes from China. So that's the reason why this is a heavy and massive sell-off from, 187 all the way back down to 178. So let's take a look at what I've been doing. I have been buying Apple a lot here. 179.76. Today I'm down. Actually, I'm down from my total return minus $8.65, but my equity is close to $2,000 or so. For portfolio diversity of 7%. So, I still am a firm believer in Apple. I think the China headwinds are a major concern, but I believe that if the trade deal actually does happen, and no one knows when this trade deal is going to happen, no one knows when, President Trump is going to strike a deal with China. But if it does happen, I do see the markets, going back up from that trade deal. But no one knows when it's going to happen, and until it does. These markets are going to be quite volatile. So Apple, again, guys, you guys can see my position, 10 shares, and I'm quite happy with these 10 shares. I'm just going to hold it out here and see what it does. I mentioned in beginning in the video that there was one industrial that sort of just caught my interest. I've been looking at my watch list lately in the Seeking Alpha, and one of the industrials that I've been watching for quite some time is 3M, and 3M is now in the portfolio, guys. So in the last video, I did say I was trying to, as hard as I could, to avoid industrials because I just saw no end of the trading war. And this may not be an exactly good buy because right now 3M is pretty much a falling knife right here. It is down 23%, and for the past 3 months, it is down 20%. So you guys can take a look at my average cost here and the amount of shares that I have bought. 10 shares for an average cost of 165.51. So my total return, I'm still up $2.40 with this stock. But why did I buy 3M? Well, that's a lot of people are saying, in the last video, you were just saying that you were trying to avoid industrials. Well, the reason why I bought 3M, guys, is because the dividend yield hit 3.5%. So that really caught my eye. And, I love these dividend stocks, these high dividend kings, if you want to call it that. Dividend aristocrats, dividend kings, and 3M. A lot of people there's been a lot of speculation about whether or not they're going to cut their dividend, but as a dividend king, I just don't see that happening anytime soon. 3M, a stock that has reached a dividend yield percentage of 3.5 in this market is very, very difficult. It's very hard to find and see that in this type of market. So I ended up buying a diversified industrial such as 3M, which really contributes to the portfolio quite nicely because it pays around a $15 dividend or so. So we're getting a dividend aristocrat at a 25% discount. So and a 3.5 yield. I mean, guys, that is absolutely incredible. And I was going to wait for 160, but the 3.5, guys, I got to jump on it on that. I got to put some money into 3M. And yeah, it can go back down to like 150 or so. And, the dividend yield would reach 4%, which I think is just absolutely insane. But I think that 3M to get 3M at a 3.5 dividend yield is quite remarkable, and that's the reason why I invested into 3M. And like I said, guys, you guys can see the graph, 20% down, so 24% just this past month. So you have to be greedy when others are fearful. And I've been in a situation like this before with Walgreens. When Walgreens was, when we all thought that Walgreens was at a pretty good buying point at $60, and it dipped all the way down to $52. So this definitely can go down much lower, guys. But I went on ahead. I got my position that I want. I'm at a dividend yield at 3.5%. I'm quite happy with that. So let's take a look at Johnson & Johnson right quick. Another dividend aristocrat. I don't know why my app is kind of opened up two apps right here, but 138 right now. The Johnson & Johnson, I'm just holding it out here, 10 shares. Portfolio diversity looks good, around 6% or so. I'm down $5, but again, the dividends are pretty nice. So let's take a look at Pfizer right now, $41.92. Shares 50, average cost $39.89, and my total return is up 101. So that's pretty good to see here. We can see some options play right here, and I'm going to quickly talk about that later on in the video. But you guys can see that my equity is just over $2,000 or so, and 9% diversity. I like Pfizer a lot. Let's take a look at AT&T, guys. Right now, $32.12. My position is 50 shares. So you guys can see that I kind of trimmed back my AT&T position and took some of the. Sometimes, guys, it's just better to lock in those profits and avoid the dividend because when you get paid dividends, the stock is going to go down anyway. So it's better to just cash out now. Wait for AT&T to go back down to like $30.75, which is my average cost, and then buy another 50 shares of AT&T. So cash out. If I cash out right now, I can lock in those profits, move some of that money elsewhere, which I did into Apple. And AT&T will not be paying, they won't have the ex-dividend date for another month or 2 months or so. So the reason why I took some of the money off the table from AT&T is because, their ex-dividend date is nowhere, around this couple of months or so. So total return, I am up $68. We can see right here, the graph kind of went back down, but we can also see some more options with AT&T, and I'll quickly talk about that later on in the video. Let's take a look at Altria right now. Altria is not having a good day, down 0.41%, and after hours it's down 0.25%. For the past week, there has been no movement with this stock whatsoever. For the past month, I am down $2.55. So let's take a look at shares 50. I am down $68. Portfolio diversity a little bit high, but I think it's pretty good to be around 10% or so. Equity $2,607. So let's take a look at my high dividend ETFs. Total stock market ETF 144. Let's take a look at average cost, still up $1,000 on this ETF, 18%. Nothing to see here, 31%. I like this ETF a lot. And finally, PowerShares S&P High Dividend ETF. Pretty good day for a down market. Right now, total return is starting to trend back here. It's up 7%, $299, 100 shares. And also, I'll be getting that dividend. You guys know the monthly dividend on top of those 100 shares, which is $15.11. Pretty good ETF, guys. I like this ETF a lot. It has a really, it's not, the expense ratio is a little bit high. It's a little bit concerning, but again, you're getting a monthly dividend yield of 4% on top of great, capital appreciation, which is up 7%. So that's something that I can't complain about. So again, guys, that seems like to be on the whole portfolio. And a stock that I ended up selling was Enbridge, and the reason why I sold Enbridge is because I had recently removed them from the M1 Finance portfolio, my Roth IRA. But after some more evaluation, I ended up putting that that stock back into my Roth IRA because I think it serves much better purpose there to be in my Roth IRA. And I was really quite up on Enbridge. I think I was up some 22%, and up $17 along with the dividends, so that was pretty good to see there. But I removed Enbridge out of this portfolio because 3M is a dividend aristocrat that is on sale. I know they're not doing good here. I know a lot of people are wondering why in the world am I buying this, especially in the last video since I said I was trying to avoid industrials. But down 25% and at a 5% yield, that is very, very hard to beat in this market. That's something that you do not see often. And let's take a look at these option plays, guys. So, one of the things about option plays, or it's quite risky. You need to know what you're doing when you trade these high volatile option plays. But we can see some puts here, and I'm going to quickly talk about why I'm doing this. So there's 4 contracts here for these put options. So when you're buying a put, let's just quickly take a look at options. I'm gonna quickly, I'm trying not to break down options because that's probably like news for another video or so. But when you're basically, if you're buying a car, you're basically saying, I think that the stock is going to go up, and if for every call option that you buy, for every contract that you buy, it's worth 100 shares. So you're basically saying, hey, if I'm going to buy a call option, I'm basically betting that the price is going to go up. So that's pretty much what a call option is. And we're talking about put options. You're betting against the stock. So you're betting against the stock. You're seeing that the stock is going to go down, and you're trying to make money off put options if the stock does go down. So again, guys, I'm not going to quickly explain what options are. I think I have just tried to explain options or tried to break it down. If you're doing sell call options, excuse me, I'm losing my words. Sell call options, you're basically saying, I'm going to buy 100 shares of the stock, and if it reaches a certain price, then I have to share my shares. And if the stock does not reach that price, then I collect a premium off that price. So quickly, again, guys, I'm just trying to show you guys what I'm trying to talk about. So you'll say I think it said sell call option right here. Very confusing, guys. I'm sorry if people are saying, why is he talking about options? But I'll quickly just go over this right quick. So sell call, you have to have 100 shares, and you're saying to yourself, okay, if it doesn't reach $33, then I collect a premium off those shares. That's basically what it is. So, but again, the reason why I'm doing this is because of passive income. And the thing is, guys, is that when we talk a look at options right here, I already own 50 shares of the stock, so I'm profiting no matter which way AT&T goes up. So if AT&T goes up even slightly, even just like, let's just say, I don't know, 10% or so, I'm still going to profit because I have 50 shares. Now, I'm going to lose profit because I have 4 contracts, and this is something that I like to call leverage put options, guys. So you're pretty much leveraging your portfolio, and you're basically saying, okay, if the stock moves down, if it moves down a lot, I'm still going to profit. So, guys, I don't know if people exactly know what I'm doing, but so this for example, Pfizer 41.92, and I did a leverage put option of about 2 contracts. Now I already own the stock, guys. I already own the stock. I have 50 shares, so I am profiting no matter which way Pfizer goes. If Pfizer goes up even slightly, I'm going to profit. If Pfizer goes down a lot, I'm going to profit. But what I want is Pfizer to go down something like, okay, so basically say over right here, the market opens up and Pfizer just takes a nasty dip like we're seeing right here. That's what I'm looking for with these put options, because if Pfizer goes down a lot, what's going to happen is I'm going to sell right about there. Yeah, right there. So right here, buy the call option, sell right there, and I'm collecting the premium, which is $10 or so. I know right now it's just $10, but the market's closed, and options don't factor into the market when it's closed. But again, guys, I'm looking for big swings down in the stock, and I think that is really good to see that my strategy is working, because you can profit from this for a whole ton of ways. So, if the stock goes down a lot, you're going to profit a lot from these put options. But if it goes up even slightly, you're going to still profit because you have a position in the stock. Now, the only negative way I see about doing this is that if the stock goes up a lot, then we're going to be losing money. We're not going to be losing money because we'll still have shares into the stock, but depending on how many shares you have, like for instance, I have AT&T. If I had like 100 shares and the stock goes up a lot, let's say if I bought a put option here, which I probably wouldn't do that, but if I bought a put option here and the stock just keeps going up, then by put options, I'm going to lose a lot of money from this put option. And so that's really the only realistic way, and there's probably other ways that I'm not talking about here, but the main way that I'm going to lose money from doing this, from these leverage put options, is if the stock goes up a lot, and I'm still going to profit from my shares, but I'm going to lose the premium off that options put. So I know, guys, it's very difficult to explain options. Again, if you don't know your options, I'm going to quickly just show you just the passive income I've been getting off options alone. This is not something that I just do frequently. This is something just to make some passive income in the portfolio because I have been selling AT&T shares, and I would like to have 100 shares of AT&T so I can get the $50 dividend. But now that I have 50 shares of AT&T, I have to wait until it drops back down to my average price. Let's take a look at my history. You guys can see it right here. So I probably need to expand this a little bit out right quick. So again, guys, let's take a look. So put option right here, May 31st, buy $78. In the same day, I sold it and I made $132. So right there, I made about $30 or so. You guys can see it right here, buy, and then right here, sell. I sold it. So, and then we'll take a look at it again. So right here, buy, put option $96. I sold it for $129. So I made money. I made another $30 off that put option. So again, what I'm doing is I'm leveraging my options plays. I'm leveraging my account because I already own shares of the company, and no matter which way the company moves, I'm still going to profit. But what I really want the company to do is have these little major downward swings. So if I buy a put option when the stock is at a doing pretty well, when its stock is all the way up some 1% or so, I buy a put option right here, and I'm hoping that people are going to start taking profits at the top. So when, for instance, if I buy a put option right here, and the markets, people start taking profits, the stock is going to dip. The stock is going to start going down and down and down. And this is right here is where I want to sell the stock and collect the premium. So again, guys, is quickly just summing up why I'm doing these leverage put options. That's what I like to call them. They may be called something else, but that's what I like to think of it, because leveraging is owning the stock. This is what I think. Owning the stock, maybe say like 50 shares to 100 shares or so, and then you're buying options. You're buying options against the stock. So if the stock even goes down heavily, you can sell the option. You can sell the option at a premium and collect some money off of it. Right now I'm down $4, but it looks like AT&T is not doing good here in the after hours. And if it continues to go down, I'll sell the contract. I'll sell the 4 contracts and collect the premium. And it looks like my portfolio is starting to take a nasty dip. Right now, the portfolio is down $32.85 for a 0.14% loss. $22,798, guys. It was a quick video. I tried to break down options as much as possible. There are tons of YouTube videos out there that really dissect options in a nutshell. I tried to do it. I tried to collect some passive income on the side because, again, compound investing, the dividend along with the premium, I think that'll be good for my portfolio. But right now, $22,798, I'm starting to trend back down in the after hours, and that's going to be that. So I'm going to wrap up the video here, guys, and I'll see you guys next time.